Welcome back. Retail sales are released 0.7% month over month versus 0.3 year over year, 3.2 versus the prior month's report of 1.6. The consumer is still very much in the economy, at least according to this report, but we're going to see long-term trends, maybe not so much. The retail sales are broken down in several different industry groups. This is the overall number in red, retail sales year over year. And you can see again, we're up 3.2%, but it is really just a far cry from where we were going back even 1 year. The blue line, by the way, is the S&P 500. And you can see retail sales really, it ticked up slightly in terms of the long-term chart. I think that the reports that we read out there are a lot more optimistic than what the actual chart reveals. Now, we can break down retail sales in several different categories. They're all very, very similar. The grocery stores year over year, we can see a slight uptick, but still actually, this is closer to the highs than some of the other numbers, but still very, very much off of the highs that we saw going back to 2020. Of course, those highs were the result of a lot of spending stimulus as a result of the COVID crisis. But nevertheless, retail sales are very much off their highs. Take a look at electronics and appliances year over year, very much off their highs, actually closer to their multi-year lows. This is non-store retailers, and you can see actually a pretty positive correlation with the S&P 500. When one line goes up, the other one does as well. But again, compare this to where we were back in 2020, it looks like we're really closer to the lows. So I don't know exactly where the optimism is coming from. If you read a lot of these news reports, they seem to be a lot more optimistic than at least what the charts indicate. Here are building materials and garden equipment retail sales pretty much at the lows that we've seen going back several years over here. This is gasoline stations also near multi-year lows. And that is probably in light of higher fuel costs, especially as of late. Here's retail, trade, and food services, again on a year-over-year basis, hugging near the lows, pretty much ignoring the S&P 500 rally, or maybe the S&P 500 rally is ignoring what we've seen in the retail sales. This is food and beverage stores and continues to make lower lows, except for today's report, which is a tick up, a tick to the upside, but it's just, I think one just tick. It doesn't look like any sort of reversal. Motor vehicle and parts dealers, this is starting to recover. There's been a lot that's been written about the skyrocketing prices of used cars. And I think that maybe, there's a difference in a lot of these charts depending on whether these particular industries are dependent or sensitive to interest rates. I think interest rates are really, they play a very dominant role here. Retail, trade, and food services. Now, this is excluding motor vehicles. And this seems to be a weaker chart than the prior motor vehicle dealers. So if you take out motor vehicles, I think the retail trade's even worse off than with motor vehicles. General merchandise stores seems to be somewhat of a strong correlation. Well, actually, maybe not so much. This is an ongoing theme that we've seen in several different reports. The S&P 500 rally seems to be really ignoring a lot of these other economic numbers. Now, this is on a month-over-month basis. This is the change from this month to last month. You can see the real winner over here, up 1.9% on a month-to-month basis. That's the non-store retailers. I would assume this refers to online shopping versus one of the big losers over here. That's electronic appliances and also motor vehicle parts dealers also down 0.3%. The electronic appliances on a month-over-month basis down 1.3%. Other strong sectors include retail, trade, food services excluding motor vehicles, retail, trade excluding motor vehicle sales and gas stations. Those seems to be up about 1% respectively. This is on a year-over-year basis, comparing this July to the prior July. The big winner non-store retailers. Again, I think that the e-commerce, the non-store retailers, that seems to be the real winner over here. Gasoline stations seems to be the big loser, in addition to electronics and appliances, which are also very interest rate sensitive. When we think about electronic appliances, we also think about durable goods. Those are those goods that are designed to last more than 3 years, and we've seen some weakness in that area as well. Motor vehicle and parts dealers up 7.6% on a year-over-year basis. And that really is probably, except for the non-store retailers, the highlight of the report over here. Again, gasoline stations are down almost 21%. All retail sales numbers, if we take all of the aforementioned reports and we put them together and average them equally, that is what we see here with the red histogram bars. The blue line is the S&P 500. And we can see on an equal footing, an equal comparison on a year-over-year basis, we are basically almost at zero. Today's report shows a slight uptick, but again, it is only a slight uptick, and it's really probably the weakest month that we've seen, except for the past 4 months. It's an uptick compared to the past 4 months, but if you take into consideration the long-term trend, it looks like we're at the lows of multi-year lows. This is the all retail sales average compared to the federal funds rates. Obviously, the Federal Reserve has raised interest rates extremely aggressively, and I think this does have a correlation as higher interest rates impact our ability to borrow money on credit cards, and the credit card delinquency rates are going through the roof. There was actually a report very recently, I think today, credit card and auto loan delinquencies are really through the roof, historic levels. And I think this is weighing heavily. Notice the big spike up in the retail sales occurred during the very center of that near 0% interest rates, about 0.25% interest rate environment, and also all of that COVID stimulus that we saw during the same period of time. Here's a consumer price index, which we could also consider to be the inflation effect. In blue, all retail sales on average. When we had low inflation, we tend to see strong retail sales, but this has really turned to the downside in light of the stronger inflation. What's curious is that as inflation has begun to wane, well, retail sales really isn't going back up. That maybe there's some underlying damage that's been done to the economy that cannot be reversed so easily. Now we look at the actual numbers over here, and on the x-axis going from left to right, we see the different components all the way to the left-hand side. That's the headline number: advanced retail sales, retail trade, and grocery stores, electronic appliances, etc. Notice, and this is on a year-over-year basis, the top line is July, which is today's report, and it shows us year-over-year basis down 21% on the gasoline stations. Notice in particular, we see a real red streak over here. Maybe the gasoline stations acts as kind of the canary in the coal mine because it seems to be very, very volatile. You go back to June of last year, we were up 49% on a year-over-year basis. And of course, June 22 compared to June 21. Now we're, comparing these numbers to what we saw during the COVID crisis, 2020, 2021. So maybe that's not a fair comparison. But in particular, notice if you go from left to right on the top, up 2% year over year, 2%, -3, +10, -3. Except for the gasoline stations, we're pretty much flat, maybe a little bit above zero, which is the average we can see. If you go back in time, then we see higher numbers. So, for example, if you look at October of 22, the overall number was up 8% versus a current 2. We see grocery stores that were up 8% year over year versus the current 2. So really goes to show you, building materials, garden equipment was up 9%, now down 3. Compare and contrast this to what we saw in 2008 and 2009. In particular, again, notice the gasoline stations that were up around 18, 20, 25, 27% year over year sent in the middle of 2008. This is before the real financial crisis took hold in late 2008. Notice how October, November, things went from good to bad very quickly. Gasoline stations went from up 20% to down 24% in a course of 2 months. Now, we don't mean to compare, to allude to the fact that we're repeating 2008. Maybe we are, but we just look for patterns in history to see if, the current pattern, the current market follows the previous pattern. Maybe we can gain some insight on that. So you notice how things looked very good early 2008 and then turned bad in 2000, late 2008, obviously going into 2009. Notice the overall number was up 2%, 1%, barely positive in mid '08, and by late '08 we were in the negative territory. Again, compare and contrast this to where we are now. This is back where we are now. We're barely positive on the overall headline number, and we've gone from good to bad on the advanced retail sales for gasoline stations, as an example. So it's very interesting to see how, if you read the headline numbers, they said, well, the retail sales is up a lot, and it is compared to last month's year-over-year report and the past few reports. But if you zoom out and you take a look at the long-term trend, we're barely positive. And comparing this to history, well, the numbers kind of match up to what we saw beginning mid 2008. Will history repeat itself? Well, only time will tell. But very interesting to see if the pattern does develop. We hope this has been helpful. We look forward to seeing you back soon.